Many people assume great fortunes are created by discovering one incredible investment, a brilliant stock pick, a lucky opportunity, a moment of perfect timing. But if you study Warren Buffett carefully, something remarkable appears. His wealth was not built from one idea. It was built from a system of thinking, a way of making decisions that consistently avoided major mistakes, identified durable opportunities, and allowed compounding to work uninterrupted for decades. Buffett did not chase brilliance. He designed a life structure that allowed wealth to grow naturally. When you examine the real foundations behind his fortune, you begin to see that the secrets are not mysterious. They are principles, but they are applied with a level of discipline and patience that very few people sustain. Let's walk through the deeper forces that actually built Buffett's wealth. 1. The most powerful advantage: time. The most underestimated element of Buffett's wealth is not intelligence. It is time. Buffett bought his first stock at 11 years old. That means his capital had over 7 decades to compound. This matters far more than most people realize. Compounding is not linear, it is exponential. In the early years, progress looks almost invisible. Returns accumulate slowly, and the numbers appear unimpressive. But after enough time passes, something dramatic happens. Growth begins accelerating on itself. Buffett once described his fortune as a snowball rolling down a hill. The snowball grows because 2 conditions are present. The snow is sticky, the hill is long. In this analogy, good investments are the sticky snow, and time is the long hill. Most people focus entirely on finding better snow. Buffett focused on finding a long hill. The extraordinary size of his wealth is largely the result of allowing compounding to operate uninterrupted for most of his lifetime. In fact, the majority of Buffett's net worth accumulated after age 60. That fact alone reveals how powerful patience can become when combined with compounding. 2. Temperament over intelligence. People often assume Buffett succeeded because he is extraordinarily intelligent. But Buffett himself repeatedly emphasizes something different. He says the most important trait for an investor is temperament, not IQ. The markets constantly create emotional pressure. Prices rise quickly, and people feel excitement and greed. Prices fall suddenly, and people feel fear and panic. Most investors get pulled into this emotional cycle. They buy when prices are high because everyone else seems confident. They sell when prices collapse because everyone else seems scared. Buffett trained himself to behave differently. Instead of reacting emotionally, he treats market fluctuations as opportunities created by other people's emotions. When fear spreads through the market, assets often become cheaper. That is when Buffett becomes interested. His famous rule captures this idea perfectly. Be fearful when others are greedy, and greedy when others are fearful. This ability to remain calm while others panic is not simply a personality trait. It is a strategic advantage. Because in markets, emotional discipline often determines who captures the best opportunities. 3. Buying businesses, not trading stocks. One of Buffett's most powerful mental models is that he does not think like a trader. He thinks like a business owner. When most investors look at a stock, they see a fluctuating price chart. Buffett looks at a stock and asks a completely different question. If I owned the entire business, would I be happy holding it for many years? This mindset changes how investment decisions are made. Instead of chasing short-term price movements, Buffett evaluates the quality of the business, the durability of its competitive advantage, the reliability of its earnings, the long-term demand for its products. This philosophy led him to invest in companies with powerful economic foundations. Through Berkshire Hathaway, he acquired large stakes in businesses like Apple, Coca-Cola, American Express, See's Candies. These companies were not chosen because they were fashionable. They were chosen because they possessed economic durability. Buffett understood that owning great businesses for long periods can produce extraordinary results, even without constant trading. 4. The power of economic moats. Buffett often describes great companies as businesses protected by economic moats. In medieval times, castles were surrounded by moats to prevent attackers from entering. In business, a moat serves a similar purpose. It protects a company from competition. A strong moat may come from brand power, cost advantages, network effects, customer loyalty, Regulatory advantages. For example, a brand like Coca-Cola has enormous global recognition and distribution. That makes it extremely difficult for competitors to replace. Buffett searches for companies with wide and durable moats because they allow profits to continue growing for many years. Without a moat, a successful business attracts competitors quickly. With a moat, the company can defend its market position for decades. Buffett's wealth grew largely because he identified businesses capable of sustaining profits far into the future. 5. Avoiding big mistakes. Another critical element behind Buffett's success is something surprisingly simple. He works extremely hard to avoid catastrophic mistakes. His investing mentor, Benjamin Graham, taught him that protecting capital is just as important as growing it. Buffett often summarizes this philosophy with two famous rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Of course, losses sometimes occur in investing, but Buffett's deeper point is about avoiding permanent loss of capital. Many investors destroy wealth through reckless decisions, excessive debt, speculation, chasing hype, overconfidence, complex investments they do not understand. Buffett avoids these traps by focusing on simplicity and rationality. His strategy is not about being right all the time. It is about ensuring that when he is wrong, the damage is limited. Over decades, this discipline allows compounding to continue uninterrupted. 6. The circle of competence. One of Buffett's most important ideas is something he calls the circle of competence. This concept is incredibly simple, but extremely powerful. Every investor understands certain businesses better than others. Instead of pretending to understand everything, Buffett restricts himself to industries he can evaluate clearly. If a business falls outside that circle, he simply ignores it. This discipline protects investors from one of the most dangerous behaviors in markets: overconfidence. Many people believe they must constantly chase the newest technologies or emerging industries. Buffett does the opposite. He focuses only on opportunities where he feels confident in understanding the economics of the business. And surprisingly, that limited circle has been more than enough to build extraordinary wealth. 7. Patience as a competitive advantage. In most areas of life, speed is rewarded. In investing, patience is often more valuable. Buffett has spent long periods doing absolutely nothing. Sometimes years pass without making major investments. For many investors, this feels uncomfortable. They feel pressure to constantly act. But Buffett understands something crucial. Great opportunities do not appear every day. When they do appear, however, they are worth waiting for. He once compared investing to baseball. Except in this game, there are no called strikes. You can watch thousands of pitches go by without swinging, but when the perfect pitch finally arrives, you swing with conviction. This patience has allowed Buffett to deploy large amounts of capital only when the odds strongly favor success. 8. Capital allocation mastery. Buffett is not only an investor, he is also one of history's greatest capital allocators. Capital allocation is the process of deciding where money should be invested to produce the highest long-term returns. Through Berkshire Hathaway, Buffett constantly reallocates capital across different opportunities. Profits generated by one business can be reinvested into acquiring another company, purchasing stocks, expanding existing operations. This structure creates a powerful internal engine of compounding. Instead of withdrawing profits, Buffett continuously redeploys capital into opportunities that strengthen the entire system. Over time, this process transforms individual investments into a self-reinforcing financial ecosystem. 9. Reputation and trust. Another hidden factor behind Buffett's wealth is reputation. In business, trust can become a powerful financial advantage. Because Buffett is known for honesty, discipline, and long-term thinking, many business owners are willing to sell their companies to him. They know he will preserve their legacy and treat their employees well. This reputation allows Buffett to access opportunities that may never appear in public markets. Deals often come directly to him because sellers trust him as a long-term steward of their businesses. Over time, that trust has opened doors to some of the best investment opportunities in the world. 10. Simplicity. Perhaps the most surprising secret behind Buffett's wealth is simplicity. In an industry filled with complex financial models, complicated derivatives, and endless speculation, Buffett prefers straightforward ideas. He invests in businesses that are easy to understand. He avoids unnecessary complexity. And he relies on principles that remain stable over time. This simplicity allows him to focus on the fundamentals that truly matter: durable businesses, rational prices, long-term ownership, disciplined decision-making. In many ways, Buffett's greatest strength is his ability to ignore noise and focus only on what actually creates value. In summary, the secrets behind Warren Buffett's wealth are not hidden formulas. They are enduring principles practiced with unusual discipline. Start early and let time compound your capital. Develop emotional control so markets do not control you. Buy strong businesses instead of chasing short-term price movements. Stay within your circle of competence. Avoid large mistakes. Be patient enough to wait for the right opportunities. And allow compounding to work quietly for decades. None of these ideas sound extraordinary on their own, but applied consistently over a lifetime, they can transform ordinary investing into extraordinary wealth.